Hi folks, and welcome back to Meaningful Money. Okay, I'm just outside the village of Madron. I've been in this precise spot before actually, but the camera was pointing in that direction, which is down towards Mounts Bay. But it's no good today because the wind is in that direction, and so it'll be hitting me and the microphone directly in the face. So not the most inspiring of backdrops, but it's the content that matters. Carrying on our series about long-term care, we need to move on to what sort of insurance and investment products are around. I'll give you a clue, there aren't many. Which can help you pay for care or plan for having to pay for care at some point in the future. So as ever, before we dive in, I must thank my good friends down here at 7 Investment Management who sponsor Meaningful Money, so thank you very much to them. So we've talked about who provides care, and we've talked about the financial assessment for care in the last 2 videos. But what about the market for products and investments which are specifically aimed at long-term care? Well, as I just mentioned, there isn't any, or hardly. There used to be something called pre-funded long-term care insurance, and it was an insurance policy, very often a single premium, so you pay a one-off premium, or sometimes regular premium, and it was simply an insurance that if you needed to go into care, it would pay out. So you could take it out for part of whatever your care fees might be. You take it out for sort of a fixed weekly amount. Maybe it could be indexed to go up each year or whatever. But anyway, it's a bit of a moot point. Not a lot of point in talking about them because you can't get them anymore. But if you have one of those in place already, then perhaps keep hold of it, but certainly take advice on it. You could also get long-term care investment bonds. We've talked about investment bonds a long time ago now. I can't remember what the episode number is. But these were sort of long-term care specialised ones where every month a chunk of your units in the investment were surrendered to pay for a long-term care insurance. And it was a kind of a combination of an investment and an insurance against long-term care. But again, the last one of those was withdrawn, I believe, last year. So no good. So we'll have to move on. Those were pre-funded long-term care plans. But now all there is something called post-funded. So in other words, if you need funding for long-term care now, you're going into care now or imminently, then there's a couple of things you can think about. The first one is called Immediate Needs Annuity. And the second one is some form of equity release. And that's a big enough subject that I'm going to deal with it in a little mini-series on its own when I'm done with long-term care. So that leaves us with one option, process of elimination, which is an immediate needs annuity. And it's a little bit like a conventional annuity, one that you'd buy with your pension fund. And for information on that, you need to go back to episodes 53 to 55. But it's different in some important ways. The first thing is, this is not a pension as such. What you would do is you would take a lump sum of money that you had in the bank or in investments and use it to buy an annuity. And that annuity would be paid usually to a care home provider and pays your fees for you. But because you're taking a lump of your money, not pension money, but a lump of your money and buying an annuity with it. Annuity, remember, is just an income for life, and that income is sort of divided notionally into 2, into income and return of capital. So not all of the income payment is taxed, just part of it, most of it, but part of it. The older you are and the worse health you're in, the greater of your monthly income payment that you get from an immediate needs annuity, the greater part of it is capital rather than income, so you pay less tax. That's the first thing to say. So that's the sort of a major difference from a pension annuity that you might buy, in that it's both income and capital return, so it's not all taxed. But even better, if you opt to have your annuity paid direct to your care provider, so let's say you go into a home and you decide you're going to set up one of these plans and you arrange for it to be paid direct to the care provider, then the income is entirely tax-free. So that's a pretty valuable perk and worth knowing. Now the cost of that income, so how much lump sum you have to hand over in order to secure the income you need, depends on all sorts of factors. Your age, obviously, whether you decide to have it increasing each year, you know, care fees increase significantly ahead of inflation usually, so you might want to build in some kind of automatic increase every year. You can opt to have an annuity paid for life, or maybe just for a fixed term. You know, maybe you think, well, I'll sort out the first 5 years. If I'm in care for longer than that, then, you know, I'm just going to have to lump it, or perhaps I'll buy another one then. But just to sort out the first 5 years, or for the rest of your life. So depending on which of these options, you know, whether you choose for a capital guarantee, so that if you die early, a chunk of your capital is paid back to your beneficiaries. All these options, like with ordinary annuities, the more options and bells and whistles you add on, the more it costs you to buy the income you need. Now, your state of health is obviously a factor, and they would measure that. Well, there's two aspects really of your health that they would take into account. Obviously, the worse health you're in, the cheaper it's going to be to buy the income you need, because your life expectancy is reduced. So immediate needs annuities would be underwritten, and they'd look at your health on two aspects. One would be your sort of cognitive and mental impairment, so Alzheimer's and things like that, and there are standard tests for doing that, for checking out what stage you would be at. But the other thing is something called activities of daily living, and these are an important concept when it comes to long-term care. So an annuity provider would measure your health based on, partly at least, on these activities of daily living. And they are washing, dressing, mobility, transfer, that's sort of getting out of a bed into a chair and back again, feeding yourself, and toileting, so being able to use the toilet or whatever sort of surgical aids might be necessary to help you do that. So there are definitions of those activities of daily living, or ADLs, and depending on whether you can't do, say, 3 or more of those, or 2 or more of those, then that would affect the cost of buying the income you need via an immediate needs annuity. All right. So that pretty much is now your only choice. So if you decide you need care, or you're imminently going to need care, you can arrange for one of these to set up a regular monthly payment, ideally to your care provider, because it's tax-free and it's sorted, it looks after itself. But there's all sorts of options and bells and whistles, so you must always, of course, as I always say on here, take advice from a competent advisor. And this is a specialist area, so you need to find out whether your advisor knows his stuff. So the alternative, as I mentioned earlier on, alternative such as it is equity release, but I'm going to deal with that in due course in 2 or 3 videos time. So next time we're going to look at state benefits, and particularly those that you might need to think about if you're going to need long-term care. So from my field in just above the village of Madron, thanks for watching, and I'll see you next time.